Hello traders, you're welcome to this video. In this video, we are going to be looking at a strategy that combines the moving average convergence divergence, the relative strength index, and the commodity channel index. So the strategy comprises of these powerful indicators, okay? And we're just going to be looking at a detailed guide on how you can use these indicators together for effective entry and exit point identification. Okay, now first of all, we're just going to be looking at an overview of each of these indicators. So we're going to be starting with the MACD. Okay, the purpose of the MACD is to identify potential buy and sell signals, right, in this strategy based on convergence and divergence of two moving averages. Okay, now the components of the MACD are as follows. The MACD actually gives us, difference between the 12-day and 26-day EMAs. You can see that, okay, I'm just going to change this to this, all right. Okay, so the MACD line indicates the difference between the 12-day and 26-day EMAs, while the signal line is the 9-day EMA of the MACD line. Now, the histogram bars are the difference between the MACD line and the signal line. So, the MACD usually helps us identify momentum and trend direction. When the MACD line crosses above the zero line, okay, it indicates bullish signal, and vice versa for bearish signal. That is when the MACD crosses below the zero line. Okay. Now, as for the RSI, let us add it on to our chart. The purpose of the RSI is to measure the speed and the change of price movements. It helps us identify overbought or oversold conditions. So as we can see, the RSI ranges from 0 to 100. Generally, an RSI above 70 indicates overbought conditions, okay? While an RSI below 30 indicates oversold conditions. Okay, so the RSI helps provide clear signals for potential reversals based on market momentum. It helps traders to avoid entering trades at extremes. Okay, now as for the final indicator for this strategy, which is the CCI, we're going to be adding the CCI to our chart as well. The CCI evaluates the current price level relative to an average price level over a specified period, indicating potential overbought or oversold conditions. Now, as for the range of the CCI, as we can see, the CCI can go above plus 100, indicating overbought, or below minus 100, indicating oversold. Now, the CCI helps identify cyclical trends. It helps us identify cyclical trends, which can help traders anticipate reversals and identify the strengths of trends. Okay, now how do you combine these indicators? How do we combine it? To create a robust trading strategy, we might consider using these indicators together, not one after the other, or not one at a time, rather together to confirm signals. Okay, so how do we do that? After adding all the indicators to our chart, it's important we do that first. Then we will start by looking for, if it is for a buy trade, we're just going to use the buy trade as an example. So we're going to start by looking for a bullish crossover on the MACD. The MACD line should cross over the zero line, and then we're going to use the RSI for confirmation. How do you confirm with the RSI? When the RSI is below 30, that is the oversold zone, or moving up from this level, this confirms buying pressure. So in this case, we had the RSI moving up. It was already moving up. It had not yet entered the overbought, but it was already moving up. As you can see, after the crossover, it was already moving up, but then it began to go sideways. So this is not exactly a very good confirmation. We don't want a sideways movement. We want an upward movement. So we're just going to look for another example. Okay. So all right, we have seen a good example here. Now we see that the MACD crossed above the zero line, and then we see that the RSI was moving upwards, was actually moving upwards. So that confirmed the signal. After the RSI entered the overbought zone, it doesn't mean that the trend is going to stop immediately. We have to wait for a movement down a signal from the RSI when the line points downwards. You can use that to now exit the buy trade. However, when you have the RSI trending upwards and the MACD crossing above the zero line, it gives a bullish confirmation. Then the CCI also confirms the trend if the CCI is above the minus 100. It's above the minus 100. You can see that it's above the minus 100. It's above the minus 100. Now, if you look here, you see that price valid all the way up to this point. Okay, it's valid all the way up to this point. So this is a practical example of how you can combine these indicators. You need to see a crossover from the MACD. You need to see a bullish move from the RSI pointing upwards. You need to see a bullish move from the CCI pointing upwards. The CCI and the RSI should be trending upwards. Then even if they enter the overbought zones, wait for the lines to begin to point downwards. The CCI began to point downwards around here, the RSI began to point downwards around here. So we would have considered exiting after we had this downwards point. So we would have exited somewhere around here, which coincided with a resistance level. That would have been our good exit point for the buy trade that we would have entered right after the crossover, which was somewhere around here. We would have entered the buy somewhere around here. You can see just right after the crossover. So we would have caught somewhere around this is the daily time frame. It's the daily time frame, so about 1200 pips. That's a very good catch, although it would have lasted for somewhere around 1, 2, 3, 4, 5, about 5 to 6 days, or about a week, or about a week and a half. Talking about trading days. Okay, so but it was a good catch. Okay, now as for the exits, we can actually use bearish crossovers from the MACD to exit our trades. We can use resistance levels. We are using the buy trade as an example. Remember that the sell is just the opposite, okay, of the buy. For the sell, bearish crossovers, RSI pointing downwards, CCI pointing downwards. When it's for exit, when it enters oversold zones, begin to point upwards. That's for the exit of a sell. The MACD entering there below the zero line, beginning to cross over upwards, below the signal, below the zero line, and gives us a sell signal, beginning to point upwards and cross above the zero line gives us a buy signal, which means we should exit our sell. So it's just the opposite of the buy. So the exit signals for your buy, you can consider using your resistance level. So you can wait for the MACD to begin to point downwards, crossing over the histogram bars. You can see that the MACD line crossed over the histogram bars and begin to point downwards. So that can be an exit signal. And then for the RSI, inside the overbought zone, beginning to cross downwards, and then the CCI beginning to cross downwards from the overbought zone as well. That can be exit signals for a buy. Okay. Now some tips for analyzing market trends. Okay, it's important to select a good time frame. Higher time frames should be used for trend analysis, like the daily or the weekly time frame. The lower time frame, like 15 minutes or hourly time frame, can be used for precise entry and exit points. Okay, then you can also consider looking for divergence. If the price is making new highs, but the MACD or RSI is not, it can indicate a potential reversal. And then it's important to combine with price action. Use candlestick patterns and support and resistance levels alongside these indicators for stronger confirmation. Okay, as you can see, I added support and resistance levels here. They are very important. You can also use trend lines, just for additional confirmation is important because these levels can give you good points for continuation, good points for reversals, good points for entering and exiting your trades. Okay, and it's important to avoid choppy market. This strategy works best in trending markets. Okay, it works best. These indicators, they work best in trending markets, so you might want to avoid using them in sideways or choppy markets. When you are using these indicators together, this strategy works best in trending markets. Okay, so by combining the MACD, the RSI, and CCI indicators, you can create a robust trading strategy that leverages the strengths of each of these indicators. Okay, it's important that you always confirm your signals with at least 2 indicators before entering a trade. And remember to adapt your approach based on market conditions. Okay, so that's very, very important. And do not trade with an amount you cannot afford to lose. Make sure you observe proper risk management. That's very, very important. I hope you found this video insightful. Kindly like and subscribe for more trading insights. Cheers and happy trading.